Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Neil Dutta with us right now with Renmac here on the CPI here. He's had 1 minute and 51 seconds to digest the data.
An eternity, yes.
I'm sorry, Neil Dutta, but it does go to not only year over year coming in a bit on core, but month over month. Dare I say, Neil, you nailed this.
You can say that. Thank you, Tom. We're still going through it, but I think a rough rule of thumb is you basically take core CPI and cut 1/10 off of it, and that kind of sets the table for core PCE. So
can you model core PC under 3% into 2025?
I mean, look, it looks like we're doing that the last couple of months. I think what matters right now isn't so much is inflation cooperating, because I think there's a very strong sort of fundamental case to make for why inflation should cooperate. The issue is whether the Fed's going to play along, right? I mean, if you look at where the Fed is and how they shifted from the September FOMC to the December FOMC, in September, they thought the risks to the unemployment rate were skewed to the upside, and they thought that the risks to inflation were basically balanced. In December, despite very modest, I would argue modest movements in the data, they completely flipped, right? So now they see significant upside risk to inflation, and they see balanced risk to the unemployment rate. And I think that's important because it opens the risk of a passive tightening of monetary policy. Like, just because the inflation data have cooperated, does that mean the Fed's going to start cutting in March? No. Because they want to wait and see what happens at the other end of Washington, D.C. And so, I think there's a risk here where you continue to see kind of slowing nominal growth and the Fed kind of sitting back and waiting. And obviously that passive tightening of monetary policy could put additional pressure on the economy.
Neil, what's your sense of how long it's going to take to get that kind of clarity, for the Fed to get that kind of clarity of what's happening down Pennsylvania Avenue from the Eccles building? We're fumbling here trying to figure out how soon we'll get it.
I mean, David, you need to ask a political analyst, not me. I mean, and it's also about the sequencing of policy, right? I mean, there was clearly a change in the Fed's tone from November to December. In November, the day after the election,
they're having to reckon with this finally. What might happen?
I mean, we need to see whether the administration kicks off policy with a round of tariffs. I mean, frankly.
Okay, that's fine. Neil, now, I want to stay with Neil Dutta here. Ben Laidler's waiting. Laidler said he's not coming on until the Dow's up 600 points. We're not there yet. The Dow up 542 points, SPX up 81 points. We're up about 1.3%. NASDAQ up 1.7%. Small caps, good morning, Robert Teeter, nailing that, up 2.6% on the Russell. As Lisa mentioned, the yields come in. The real yield comes in from a 233 launches to 2.25% as well. We're going to get to Ben Laidler and Freya Beamish. We are commercial free across the nation in this hour. Good morning on the Pacific Rim evening as well. Out on YouTube, subscribe to Bloomberg Podcast. Neil Dutta, let's talk about this, and it's delicate. Don't give me, William McChesney Martin, LBJ in Vietnam. I'm sorry, the Fed is affected by politics. How will the Fed be affected 9 days after the inauguration?
Well, I think they're going to be we already know they've put in some kind of conditional estimates for, many of them have, for tariffs, maybe deportations and a new immigration policy, and potentially fiscal reflation. So I think, to the extent that policymakers, in Congress are sounding optimistic about something getting done, I think the Fed's going to be in a wait and see approach, at least until then, to see what the details of that legislation will ultimately be. And there's a lot of obviously uncertainty around what the president might do. And I do think the sequencing is important. And if he kicks off with a round of tariffs, I think the Fed's likely not going to be in a forgiving mood with that. This isn't like 2017, 2018, where the Fed ultimately kind of felt the market and eased, right? This is, we're coming off a period of very, very high inflation. So the Fed's going to be concerned about inflation expectations and what tariffs might do to that.
Neil Dutta, thank you so much. We just got up to, we was with Renmac, I should say. Neil Dutta, just incredible work out on LinkedIn as well. Folks, we got up to 580 points up on the Dow. So now we're going to go 20 points early on Ben Laidler.
Generous of you.
Right now.
Make an exception.
Benjamin Laidler, more than anyone I know, got out front of the pre-pandemic bull market. And more than anyone I know, even Yardeni and Campora, Brian Belsky at BMO, Stolfus over at OPCO, Ben Laidler was out early saying, this is an extended bull market. Ben, over in London, thank you so much for joining us this morning with Bradesco BBI. Ben, on a baseball analogy, what inning are we in? How's the length of the bull market going?
So what game's that? We don't play very much of that over here. So I listen. We've just I think had a little bit of relief right now. Markets sort of getting themselves in a bit of a tizzy that we were having a sort of a bit of a bond shock, that the Fed was not supporting us anymore, that inflation was going to back up again. I think this number now has just given us all a little bit of pause for relaxation, and maybe allows us to refocus a little bit on there's a lot of other stuff going on. Earnings season is just off to what looks like a pretty good start, and it looks like we're going to get double-digit earnings growth, which let's not forget, I think is the core foundation of this bull market. And we're looking forward to the Trump inauguration on Monday, where I suspect the market braced for tariffs is maybe not going to get what it was maybe priced for.
In your study, if we get level, or dare I say gloom, higher 10-year yields, Ben Laidler, corporations adjust and adapt to that, don't they?
Yes, I think so. It's not good news. Higher bond yields in the US basically mean two things. It puts some pressure on valuations because US corporates have big valuations, and a lot of that value is very far in the future, so quite sensitive to higher bond yields. One, and two, about a third of US corporate earnings come from overseas, and those earnings come under sort of some pressure with a stronger dollar, which comes with higher bond yields. So those are the two negatives. But you're absolutely right. Corporates have been deleveraging. Corporates have very high profit margins. Corporates, the one thing we've learned in the last few years is how adaptable US corporates are. So, I'll take it as a moderate negative if bond yields are sort of moving higher. But A, I think corporates are able to adapt. And B, let's also remember why bond yields are moving up. One of the big reasons is the economy is doing very well. This economy is on track to grow, nearly 3%. That's why earnings are growing double digit. And as I say, the broadening of this and the continuance of this is the core support of this continued bull market.
So you pick this apart. Looking at energy, that's really the culprit here, Tom, when you look at CPI, where you do see that sort of inflationary force there. Ben, let me add, you mentioned just a moment ago taking a pause for relaxation and reflection. How long is that pause likely to last? How do you navigate this period when you can exhale for a short moment at least?
Maybe till Monday. No, in all seriousness, there's a lot of cross currents here. We're feeding our way through, we're just kicking off earnings season. It's a pretty big earnings season. We're looking for this rebalancing, away from big tech, which has done all the heavy lifting, towards everybody else. If that happens, I think that is, fundamentally very bullish. We've got to get through the Trump, inaugurations, a lot of uncertainty as to what, that's going to mean. But again, I think markets are sort of braced, or at least partly priced, some of that. And again, my earlier comment, I take these higher bond yields a little bit in my stride, because A, I don't think they're really signaling a dramatic resurgence of inflation, and B, I think they're a function of the fact that the economy is in a pretty good place. And if we did get a little message today that maybe this is a story of inflation stabilizing rather than anything more sinister happening, then I think that's all good news.
Is there an opportunity, Ben Laidler, in United Kingdom stocks? I mean, they got a government in an uproar. Full disclosure, folks, I can't keep track of it. I try to read about it. I have a cup of I have
Canada
coffee.
preoccupying you
Pharaoh
as well.
has tea.
Yeah.
Ben Laidler, do you drink coffee or tea?
I have to be a tea drinker.
It's like brown water. I don't get it. Ben, is there an opportunity in arbitrage almost within the United Kingdom, given all the political and cable gloom?
I would actually broaden this. I think it's US versus the rest of the world at this point. I mean, we've talked a lot about sort of US exceptionalism. I think that continues to sort of push ahead here. And the rest of the world has just got very small, very cheap, and with higher US bond yields, which is a higher risk-free rate, a stronger dollar, just it's piling more misery on. And I think that story probably remains in place, at least in the very short term. But I think as we look further out, the opportunity is in the rest of the world. This US exceptionalism will ultimately fade, or maybe this bull market will broaden, and I think the US will be absolutely fine. But I think the real opportunity may be later in the year, once the dollar stabilizes, once bond yield stabilizes, this bull market begins to broaden. It's going to be in these 30, 40, 50% valuation discounts that you have in the rest of the world, including the UK right now.
Ben, what is going to be the catalyst for the broadening, the growing of breadth that you're talking about there as you see it?
So I think there's two. So I think one, within the US, which I think will bleed globally, is just tech earnings beginning to spread out to the rest of the market. And I think we're going to see, we're going to see that some of that this quarter. And I think secondly, more globally, it's going to be maybe a little bit of relief starting on Monday if we don't see, full ball tariffs on day one. And along with that, maybe a stabilization of the dollar. I mean, we've had this massive dollar rally, some stabilization of the dollar, some relief on tariffs. I think that opens the door to the rest of the world to get a bit of relief. And remember, a little bit of love goes a very, very long way in the rest of the world because it's got so cheap, so small.
David, we called it right. Laidler came out with Dow futures up 580, and they're now up 644.
Well done.
I mean, Laidler's rocking the bull market. Ben Laidler, thank you so much. With Bradesco BBI in London.
Take him to a baseball game next time he's in town.
Christmas Eve 2018, he and I are opening presents, and he's like, Tom, up.
Yeah.
Nailed it. He was at HSBC at the time. It was a great call.
Christmas.
I got ducky bumps. I got Neil Dutta. I go to Ben Laidler.
It's a technical term.
It is. It's CFA. And then I got
red dye number 3 might cause that. I don't
Freya
know.
Beamish, chief economist at TS Lombard. And yeah, we can do inflation, and the market's up like a moonshot, up 1.5%. Freya, the gloom out there is OMG, China's going to fall into the Pacific Ocean. You're expert at this. Is the big underestimation for 2025 that China will right the ship, China will heal, and will move forward constructively?
I think there's a lot of sort of sequencing that we can derive something useful from at this stage in terms of the legislative agenda in China, and actually also in terms of the US as well. I think with China, they're sort of at the stage where they're having to jawbone a lot, and markets just don't like that, understandably. They've said all of the sort of the good news, but they haven't given us the numbers. But because of the new administration coming in the US, and because everything is on the table, like we call this a trade deal, but it's not a trade deal, it's an everything deal. Fiscal policy is on the table. So that has to be a part of the negotiation process in the relationship between the US and China. And at the same time, the tariff story from the US, they have to sort of come in big. But at the same time, when they get to negotiating with China, I think that fiscal policy that we're all waiting for is a part of that negotiation process, so that China can't fire too soon on that. In addition to the fact that they do have their own kind of legislative agenda that has to be sort of worked through. So from that perspective, I think there could still be some good news in the pipeline, specifically with regards to redirecting towards consumer orientated fiscal policy, as opposed to just this let's use excess supply to solve problems of excess supply, which was always going to be deflationary, always going to crush returns in China, and just has been proven not to be working very well. I don't think the real economy is going to turn around very quickly, but we could, in terms of the news pipeline, finally get some numbers that could help things out.
Freya, what do these conversations, this dialogue look like? And I'm not talking about what the scene's going to be like at the Dutta guest house, where there's going to be that long table with 12 people on one side and 12 on the other, and 30 feet between them as they hammer this out. Is this going to be a constructive negotiation as you see it, sort of looking at sort of the way that China responds to whatever this president-elect puts in place when he gets back to the White House?
I guess the worry is that the big difference this time around is that for a significant proportion of the incoming administration in the US, these tariffs are supposed to be used for fiscal revenues, and to actually sort of get past the Byrd rule in the US legislative process, then they sort of have to figure in some way, unless there's some real significant hijinks up the sleeves, which is also possible. But that means that they have to sort of come in swinging from that perspective, and also from a negotiation perspective, they have to sort of come in swinging. When we hear the word kind of gradual, and the gradual is supposed to mean that tariffs are phased in from 2 to 5% per month, that makes me think, wow, that doesn't sound very gradual to me. So it has to kind of come in swinging, I think, from the US perspective. But looking to the sort of a 12-month horizon and what could really change here, I think this could be, on the table, there could be a really fundamental shift with regards to the international monetary system, with regards to the incentives that these surplus nations are offered to really change the way in which they organize their economy and restructure demand to the benefit of reducing global imbalances.
Well, T.S. Lombard, their foreign exchange strategist, Freya Beamish, is with us this morning. I'm kidding, Freya. And what that devolves down to in economics and investment is we look at the litmus paper of the system. Freya, I'm busting your chops, but the answer is you're expert at this. I mean, if you look at the dollar and all the different currency pairs as the proxy of a readjustment of the international system, what does T.S. Lombard, with all the heritage of Charles Dumas, what does T.S. Lombard suggest dollar, or for that matter, what sterling will do?
Yeah, I mean, with it's hard to see on the face of it how you can escape the strong dollar with this kind of idea of U.S. exceptionalism. Everything they do seems to tilt the balance more in favor of the dollar. And yet, when you hear someone like J.D. Vance talking to Powell in questioning, he asks, and I'm paraphrasing, what has been the effect of the U.S. dollar and its status as a reserve currency on the people of my constituency, on my electorate, on the middle income section of the distribution, and the implication is that he thinks it has not been a beneficial standpoint. And if you go back to when this current international system has its roots in the IMF in the 40s, it was the UK that was the deficit nation at that point, and the US that was the surplus nation. The UK proposal from Keynes was to punish the surplus countries by enacting a interest on the balances proportional to those surplus balances in what was called the Bancor Plan. Now that was never going to work because the US was not beholden to the UK in any way, because it was a gold system, not a sterling system. Whereas China at this stage, which is the surplus nation, is beholden to the US because it has to hold the dollars. So it cannot hurt the US without hurting itself. And that means, despite the fact that these are not allies, and the likelihood of them sitting down and talking seems very remote, there is a path there to some kind of an international system that avoids the tariffs, which China also very much wants to avoid because they're so dependent on exports at this stage.
Freya, thank you so much. Freya Beamish, T.S. Lombard.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
This is an honor, folks, and I'm not going to go into the minutia earnings. It's totally unfair to our esteemed guests. Alison Williams has been looking at bank earnings since Jackson turned America upside down.
All right.
She is taking on new duties this year. Yes, I've had 3 people email in. Is Alison going to continue to follow the big banks? Yes, fast she is.
Recreationally.
She's got like a staff of 12 to do that.
Okay.
But she's also going to be head of global strategy for Bloomberg Intelligence Worldwide, which is a huge position involved. She's got frequent flyer miles.
Good.
Like nobody
Yeah.
I know.
Get access to the lounge.
Allison, I got Goldman Sachs rolling out. It's going from a 571 up to 581. Are these banks hiding how profitable they are? I look at JP Morgan. I look at BlackRock today with the assets coming in under management. Is a basic strategy, or are they all playing down how damn profitable they are?
I mean, I think the banks are shining today.
Shining.
The numbers are good. And what's positive is really the net interest income guidance and the cost guidance. Those are two of the key things investors are focusing on. Both look at, JP Morgan guiding higher net interest income, costs a little bit higher, but, net positive. Wells Fargo's numbers also looking better. The positive on Wells Fargo, continuing to sort of move past these regulatory related costs. They damped out the fourth quarter.
In your world, do you put your radar up when Mr. Solomon wants to get into private credit? And JP Morgan's going to be right behind.
Everybody's doing it, Tom.
We need private equity. We need private equity. Alison Williams, been there, done that. Have we seen this before?
I mean, I think the positive thing, right? I mean, it's positive for bank investors, is that they're doing it with other people's money. So I think that the risk,
listen to you.
the risk in the past, right, was that
their money.
They were investing their money. Volcker changed that, and Goldman had so much money invested that they've really taken a really long time to unwind it. But I think they are using their expertise. They years ago said, we're going to use our expertise, we're going to manage other people's money, we're going to earn fees. And investors like that. They like fees on managed assets as opposed to banks investing their own money. Regulators like that. But it has been a shift in terms of the amount of credit that used to be at the banks that's now managed. I mean, BlackRock this morning, 11.6 trillion.
With a T.
I mean, that
is
amazing. Really amazing.
And folks, David's got to jump in here. The Bitcoin part of BlackRock was teensy-weensy compared to everything else.
You say the banks are shining this morning. We have seen a fresh smile on a lot of these bankers as well since the election of last year. As you look ahead to what the expectations are for 2025, for later this year, how much of that hinges on this expectation that the regulatory landscape is going to be radically different? All the talk of Mr. Barr at the Fed Reserve is going to fade into the background. All the concern about new capital requirements are going to go away. How much is this sort of pinned on those hopes?
I mean, so for sure that has driven the rally in bank stocks.
That ineffable
right?
optimism that we have.
That optimism. Yes. And, and it's interesting, Wells Fargo in particular, which has strongly rallied. We know they have this asset cap. It's been in place for many, many years. It's unprecedented. So it just keeps getting longer and longer. But, for that specific issue, we would point out that's not a political issue. Right. They have things that they need to deliver, and they will continue to work on that plan. But in general, the banks are excited. So
the banks are excited.
Have
you been in the new JP Morgan building?
It's not open yet.
But she can
No,
walk
I was in
by.
the old building recently,
okay.
but not the new one yet.
I want to mention this because this is different. Wells Fargo is up 3%. Cy, thank you. Wells Fargo's up more on a percentage basis today than JP Morgan and Goldman Sachs. Usually, David, we don't see that, as Alison
it's
mentioned.
all, and it's all about the expectations, right? Yeah. So it is, the strength of the quarter. I mean, JP Morgan's still leading the way with returns. But Wells Fargo, I mean, this is really, net interest income has been a big disappointment. Expenses have been a big disappointment. And I think the guiding is looking forward, especially since their management has tended to be conservative. Right. JP Morgan, they had already given their guidance for 2025, which was positive. Okay. We did expect a tweak. We got that. But as I said, a good set of numbers.
Cy, do we have Alison later in the morning, or is this her only appearance? Did you talk to her people? This is it, one and done.
We tried to get you yesterday, and that was because we got this news out of JP Morgan. What did you make of the shuffling of chairs, the departure of Mr. Pinto yesterday, what does that tell you about the direction of this bank post-Diamond whenever that happens?
I think it wasn't totally unexpected. I mean, Dan Pinto is sort of the person in place. He announced his retirement. I mean, the twist was that Jen got put in the COO position, so the immediate knee-jerk response was, okay, so she is the new heir apparent, and immediately
she said, no way.
Dashed.
No way.
But she did say, not at this time. Okay. So that's important, and it just may be that Jamie Dimon, this bank has built an amazing culture. They've created so many amazing leaders. They have a strong bench, and they may just want it to keep people speculating. It could be any one of these leaders. It could be Jen, it could be Marianne. Right. Doug Petno just got a nice promotion. It could be Troy. It could be Mary Erdos.
I got 8 ways to go here in the time left, but we got to go there. Over the last 10 years, folks, JP Morgan has grown at triple nominal GDP. Goldman Sachs has grown at almost triple nominal GDP. Citigroup is not. They've grown at roughly nominal GDP. I got Citigroup. Cy tells me, I can read it here, folks. It's the only way I know. 8 o'clock, Citigroup. How's Jane doing?
I think Jane is getting it done. Citigroup, as we know, back in Sandy Weil's day, he built this supermarket,
shopping mall of
everything,
finance. Yes.
And then they've been selling ever since. Corbat did come in and do some downsizing. Jane has come in and she's done more. We're going to look to see if there's an update. They're spinning off their business in Mexico. So that's going to be a big sale that'll take place later this year. And it's been a slog. It's a slog for them. They also have some regulatory issues. We talked about that. We'll be looking for their expense guidance
now that you're doing global strategy, so we're not going to be able to talk to you in about 90 days. Alison Williams, if JP Morgan's doing 3 times nominal GDP shareholder return over the last decade, a la Paul Krugman a week ago, are we seeing a concentration of capital as pre-2007?
I mean, it is interesting because coming out of the crisis, right, we have these systemic buffers, higher capital charges. JP Morgan faces, higher capital charges than their peers, and they've continued to get bigger. Part of that has been the global markets landscape, right? It's interesting to see what's happening over in Europe. With the U.S. peers have gotten bigger and bigger. Europe has not, except for UBS that acquired Credit Suisse. I don't think anyone expected GSIBs to merge. But I think what Europe needs is a cross-border deal, and it's just so difficult. It's just difficult, and the politics of it.
With Commerce Bank, Unicredit,
it's tough.
It's not happening.
It's tough.
We're out of time. Congratulations, seriously, on your new
Thanks.
Position. You should see her staff.
I've got an amazing staff.
She's got Alison's walking around our headquarters
Ravi Shaluri behind the scenes.
Shout out.
He's feeding me all the numbers.
Excellent.
Okay, Alison Williams, thank you so much with Bloomberg Intelligence here.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This has been hugely anticipated. Oil, petroleum, moved the other day so much. When Javier Blas was on, we could barely talk about what are called the softs, which are the commodities away from oil, the commodities away from minerals, industrials, and that. Kona Haque is expert. She's with ED&F Man and joins us now. Kona, coffee's a triple off of COVID, up 100% and then up another 100%, up 200% since early 2000. Is it just drought? Is the drought of the California fires no different than the drought of Vietnam and the drought of Brazil and Colombia?
Well, yes, I guess in a sense, perhaps it is all down to climate change, the fact that the extremity of it, the fact that it's so severe and so long lasting. I mean, Brazil's drought was certainly one in a 50-year event. And I think Vietnam also had an extreme drought, and California, you can see what you can see, I guess. It's terrible. But yeah, the impacts on a commodity like coffee, which is so vulnerable to climate change, and in particular variations in temperature, can really impact their yields. And yeah, it just didn't recover. So the Brazilian crop's going to be small. This is on top of a Vietnamese crop, which is also smaller than it should have been. And what we're facing with is a fifth consecutive global supply-demand deficit for coffee. And I think this is what prices are telling you, that something's got to give. You cannot kill demand fast enough. You cannot recover supply fast enough, and some prices are going up.
Are you going to give up your marginal? Are we going to substitute into tea?
No, I do tea in the afternoon, though. Coffee in the morning, tea in the afternoon.
Do you drink coffee, Kona, or tea?
I am a tea drinker, I must admit.
That brown water. Good morning, Ted Lasso.
Kona, in the pre-dawn hours, I'm fumbling around. I pick up the Financial Times this morning. There's a headline: "The China commodities supercycle is over. Will there be another?" Just an incredible deep dive into the conclusion of that supercycle. Of course, pinned so heavily on steel. What's your answer to that rhetorical question in the headline there? Will there be another one? Has the outlook changed measurably?
Yeah, I agree. I don't think there's going to be another one. It was a big one. China single-handedly lifted all commodities since the mid-2000s. And for a good 10 to 15 years, the commodities enjoyed it. But nothing lasts forever. China's maturing. It's got past the very industry-heavy, manufacturing-heavy phase of development. It's now got to focus on consumption and domestic demand, not necessarily investment-led, export-led. China can no longer be the factory of the world. It's got its own needs. It's developed its airports, it's developed its cars and factories. So now it's more about the higher level service type economy. And yes, that is unfortunately less commodity intensive. So you're not going to see much of demand to the extent that you saw before. But you might start seeing different kinds of commodities consumed, the higher value stuff. So maybe like the coffee we just talked about before. That's where they're moving towards. But no, the industry side of things, I think metals and iron ore, definitely that phase is over. And the housing sector tells you all of that. The property sector has been in a real rut for the last 3 years, and they just can't kickstart it despite record low interest rates. So it's not happening again. And we have to wait for another region, maybe Africa at some point, for the next big boom.
I would love to ask you about U.S. trade policy, tariffs policy. Of course, we're waiting for clarity on what that might look like in detail. But when you overlay that onto your world, onto the commodities world, how much does that map stand to change remarkably as a result of whatever tariffs are put in place by this president-elect?
Yeah, it's something that we're all watching very clearly and closely. So, I mean, just look what happened recently in oil, right? The fact that you've been put, okay, it's not tariff, it's sanctions, but the fact that you've got sanctions on Russian oil is now causing oil prices to get back to the $80 level, and a real movement across oil tankers and shifting, so the Saudis, China would used to be able to get it from Russia. Now they're going to have to source their oil from Saudi and the Middle East. There's going to be more of that. If soybeans gets targeted, if the US, if China retaliates and says, okay, I'm not going to take US soybeans because of the tariffs, then maybe they have to go to Brazil. So, there are lots of movements and moving parts that needs to be watched, and then who can fill the gap. I think that's the interesting thing. As a commodity trade house, that's what we look to see.
Kona, I got 30 seconds. I see olive oil. Javier emails in from London and says, ask her about olive oil. I got olive oil in Spain down 49%. Can the same thing happen with coffee, orange juice, cocoa, the others that are extended?
For coffee, not anytime soon. Maybe next year when you start seeing a crop in Brazil pick up massively. Cocoa, 49%. It's so extended, it's possible. But again, not anytime, not in the first 6 months. Eventually.
Okay.
Everything has to come to light.
Kona, please try coffee today. I beg you. Try a cup of coffee. Kona Haque with ED&F Man right now. Next time she's on, we're asking her to try Sanka.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Good morning, everyone. The Daily Look at the front page is the Lisa Mateo moment. Lisa, what do you got today?
All right, congestion pricing. We've been talking about it all the time. So yes, traffic is down. This is from the MTA. So the data says the number of vehicles entering New York City congestion pricing zone fell 8% last week compared with the average January workday from 2022 to 2024. But the problem is that this is what the Wall Street Journal is pointing out, is that the business district, which is still recovering from the pandemic, is starting to take a hit, especially the parking garages. You have parking garages. One CEO told them that they've had a 20% drop since the congestion pricing started. Then, of course, you have the different businesses in the area, too. But also, we can't forget the taxi drivers who are now complaining because less traffic means shorter rides on the meter. And there are fewer people hailing cabs, too. So this is kind of the good and the bad to it, which we knew was going to happen.
I have seen it, and I mentioned this yesterday.
We'll get Mr. Tucker in for a spirited debate with you about what you've seen.
I mean, John gets going, but, I go down Lexington and I go across 55 to Michael's Diner, and there's a lot less traffic. Fact. No question about it.
I've noticed, rolling into an early hour this week, you're getting, on my lift, it comes up. Yeah. We're getting hit with it as I come in from Brooklyn.
Didn't they give you the Bentley?
Yeah, it was on loan. Lisa still has.
Joe Weisenthal out on Twitter saying the subways are much more crowded. Next, Lisa, what do you got?
They are, and also the trains, New Jersey Transit is a lot more crowded than I know.
Maybe that's why Sweeney's not in.
Maybe he's still waiting.
Doesn't stand.
This over to the New York Times. So we've been talking about the Los Angeles fires, the air quality. So apparently the air quality is improving, but now there's another threat that's starting to remain. So the air quality measured on a scale from good to hazardous, it was good to moderate Monday, mostly good across Los Angeles Tuesday. Similar condition expected today, but the air quality manager is saying that the wind-blown dust and the ash, that is a big concern because you can have the lightest wind that can pick it up and take it across the county. And it has a lot of toxic carcinogenic material. And what they're saying is that, you can protect yourself, of course, with the N95 or the P100 mask, but they're saying the ash is something that has to really be considered and looked into now, not just the air quality, but that as well.
We were in touch with friends and family out there, and this is something I've heard anecdotally, especially folks with kids, worried about this and how much of it there is, and even if they've kind of escaped the immediate threat of the conflagration, the house is reasonably safe right now. It is a worry, Tom. What's in the air and how bad that is.
And Rob Carolyn making clear, it's not over, and if anything, it would migrate south. He did say there's a Hail Mary of some participation, perhaps, in the coming days, but it is still, for all of us exhausted by this, it's by no means over.
Right, and winds less bad yesterday than I think were forecast, but today a new day, and we'll see what it holds.
Yeah.
Moving on to the job market. This was in the Wall Street Journal, too. They're saying that even Harvard MBAs are struggling to land jobs, so it just goes to show you the perspective of what's going on. This is from the Harvard Business School itself that says 23% of job-seeking Harvard MBAs who graduated last spring were still looking for work 3 months after leaving campus. So the reason why that 3 month is such a critical figure for them is because they kind of use that to get the professionals into the school itself. But it just goes to show you the difference in how it's starting to change. But there was one school who did report an increase, like they had more students kind of being hired after, and that was Columbia Business School. But it was just
because of Abby Joseph Cohen.
That's it. That's the reason.
Single-handedly. They go in on their resume, I took a course with Abby Joseph Cohen and survived. That's why. Lisa Mateo, thank you so much. The newspapers today, and with the different layoffs and new right-sizing, Meta,
we had
Facebook,
Meta yesterday, 5%.
And Microsoft as well. I think it's worth looking at.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.